Hey traders, this is Blake Morrow with Forex Analytics, and you are listening to the week ahead video for October 16, 2022. First and foremost, thanks for spending your time with us this weekend. I also want to say, and I want to ask you, if you like these videos and you like how we prepare you for the week ahead in trading, make sure you give us a thumbs up. It's free to do that, and it's also free to subscribe to the channel so you don't miss any of these week ahead videos. Also, you know what else is free? Registering for the free Trader Summit event that is next weekend, October 21st through 23rd. There's going to be so many great speakers, and there's so many reasons to register. But I do want to say, even if you're not going to be there, register anyway, because you'll be the first ones to get the recordings like a couple of days later. Because if you don't do that, you'll get the recordings like a month later. When you randomly go to our YouTube channel, you might see them. This way they're delivered right into your inbox, which is great. Also, you know what? Our sponsors, so 8cap is giving away 2 iPhone 14s, brand new, unlocked, as a giveaway to 2 random subscribers. Also, one of our sponsors, the Trader Funding Program, is giving away 2 $250,000 assessments. So if you pass, you can actually trade our money. You don't have to risk your own money. So check that out, the Trader Funding Program, and also 8cap, our sponsors. But look at all the speakers that are going to be there. These speakers are going to be live. They're going to be taking questions from the panel. It's going to be an awesome event. So make sure that you register. Okay, let's get into the markets. And one of the nice benefits of being in the Trader Funding Program is you actually get Forex Analytics included for a period of time based on what assessment size you decide to take. So that's pretty cool. Next week is going to be still busy. We're going to talk a lot about last week. And matter of fact, we're going to break down a lot of these charts. But we do have inflation data coming out of New Zealand, out of the UK, out of Canada next week. So that means we got to actually analyze those charts. As you know, the inflation data out of the U.S. actually moved the markets quite aggressively. I'm going to actually take you over to the dollar index really fast, and we're going to do analysis here. But just remember, over the weekend, Forex Analytics does update all of the analysis, whether you're talking about macro or, mostly basic technical analysis, and the macro is updated every few days depending on, how much the market's moving. But you can see, you can read through the analysis through here and actually read it right over here. But I'm gonna go through the live chart so this way we can talk about it. So let's talk about the dollar, and let's talk about the reaction following that CPI data. Now, before I actually talk about the reaction, I just want to point out a couple of major things with the dollar. Most of you already know this, but you can see that the dollar index has been in a, this is a 2008 to current, what is that, 15-year channel higher. We're at the upper end of that weekly or monthly channel. So just keep that in mind. And we're probing it right now. If you go over to the daily chart, you'll notice that the daily chart has been in a year-long ascending channel. We also probed the upper end of it, or maybe even above it. A lot of people like to call that a throwover. But we actually created a lower high this week. So let's discuss a little bit more detail about why the market reacted the way that it did on Thursday after the CPI. First of all, the dollar actually spiked higher on that strong news. Then it reversed lower. It came down towards the 112.50, 112.40 support, and then we reversed higher at the end of the week as the market risk aversion set in. The one thing that I want to point out about the dollar is it's struggling up at these highs, and that we have to take note of. It doesn't make the dollar bearish, but it does suggest that the market is getting very tired up at these levels. Sentiment is extremely bullish in the dollar, and it's actually extremely bearish in equities. The predominant driver in the dollar right now are 2 things. First of all, risk aversion, as the market is risk off and you see stocks down at 3,600 in the S&P, the dollar is automatically going to catch a bid as a result. Also, everybody expects that since the Fed is extremely hawkish, they continue to raise rates, and everybody still looks for that fictitious possible pivot by the Fed. Every time we get some stronger economic data, that suggests that the Fed is not going to budge. They're not going to blink. They're not going to waver away from raising rates, getting to a terminal rate of 4.5% or maybe even 5%, or maybe even greater than that. So as a result, we're not going to see the dollar really start to weaken until economic data starts to show signs of weakness as well. Now, one of the things that I think that we should all be paying attention to this next week, we got to take a look at earnings. Earnings are actually earnings week started last week, but there's a lot of companies like Apple. I mean, some of the big names like Apple, Intel, Netflix. We have some financials, Bank of America. We have Tesla, Goldman Sachs. We have American Express. There's just a lot of big names. IBM is actually reporting this next week. So a lot of companies are actually reporting. And what we're going to be looking for is we're going to be looking to see, obviously, if there's beats or misses on top side earnings estimates, that type of thing. But you're going to look for what you should be looking for is what analysts or companies are saying, and if they have to cut forecasts. And that's something that if we start to see that type of weakness in underlying individual companies, then that means the Fed, that could get the Fed's attention. It's obviously going to get the stock market's attention too. But I'm going to take you over to the S&P, and we discussed the S&P weaker here. Let me go ahead and delete this really quick. I'm going to delete this. These are some of the drawings from last week that you guys know of. Anyway, we're in this big head and shoulder pattern. We're moving lower. The markets are closing in on this really critical support. Let me take you over to a different chart that might give us more of a futures type of feel. This is a CFD. Whoops. One second. There we go. Well, that's the one I was just on, but that's all right. Anyway, what you can see here is we still have some downside left in equities, but to reach targets. But also note that channel support is coming up around the 3,400 level. So anywhere between 3,400 and maybe even 3,300, where the head and shoulder pattern completes, that's going to be some major support. But notice how we closed at the 3,600 or 3,580. Do you know why that's so important? Is because if you go back and you go to the post-COVID breakout area right here, I know we've talked about this before on the week ahead videos, so just bear with me. That's a big breakout area, and you can see how big of support it is, and that's why we've highlighted these areas on this particular chart, because we've talked about it in weeks past, and you can see how big support is here. Now that we're past a lot of the economic data, the major data, for the U.S., especially with the CPI from last week, the market is still grappling with the idea that economic data is increasingly strong. That's why this next week's earnings that come out, everybody's going to be focused on it. Now, let's go back into the currency market really quick, and let's talk about some of the bigger components. Let's talk about the euro dollar. So one of the things that's holding up the dollar right now is the dollar has found really, key resistance on that dollar index, but the euro is also struggling to hit new lows. Now, I know, most people feel it's just a matter of time, because as these increasing pressures in energy in the eurozone increase over the winter time, that pressure is going to eventually weigh on the euro. But you also have to think that those higher energy costs and even slower economic conditions, but the high inflation that the eurozone is facing, the ECB may be forced to actually be more aggressive in hiking rates. And it's a big debate right now. It's a big debate amongst analysts. It's even a big debate amongst ECB members. But what we are noticing from a price perspective is the euro is holding the 78% retracement of the last move higher. And you can see that spike held last week. That's a 4-hour chart. So if you go over to the daily chart, you can see we actually held it last week. So that's going to be really important support going into the next week. Now, if you're jotting and taking notes, you should probably write down 96.30, 0.9630, because if that level is broken, my 2 cents is we are going to be challenging new lows in the euro. So we might be challenging 95 cents and possibly stops that are below that. Because you got to imagine with traders today, right? If you're a longer term, investor and you're like, look, I'm going to start selling dollars here. I just don't think it's, the dollar is going to, we're at peak Fed hawkishness, blah, 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 whatever your argument is. What you're really looking for right now is you want to make sure that these lows down here around 95 cents are not taken out. So can you imagine all the longer term, portfolio managers that are like, I'm going to start selling dollars. I'm going to start putting away other currencies, whether it's the Aussie dollar, the euro, sterling, whatever the case may be. They don't want to see a break of 95 cents. So my opinion is you're going to see a lot of stops are starting to build below that 95 cent level. So that's why I think you have to be keeping in mind if we do break below, this 96.30 level, that does put a risk into taking out all these lows in the euro. So just keep that in mind going into this next week. Let's also take a look at the sterling. There's a lot of arguments to be made that the sterling is, or has created an important low, below 105.20, that previous all-time low. I was talking to Mark Chandler from Bannockburn Forex this last week, and he made a great point. He's like, look, those lows were actually hit in Asia during periods of little liquidity, when Europeans were not around. Traders in the UK were not, in front of their computer. Not a lot of liquidity. So because of that might have been a very important low and might not even be a low that we see anymore. Now that's up to debate. I know a lot of you guys are like, well, what a mess the UK is in. One of the things that happened actually just before I started filming was Bailey, from the Bank of England, and Jeremy Hunt, who is the new Treasury Secretary in the UK, which would be the Chancellor of the Executor. Is that what the proper title is? Anyway, they were discussing that they have to make a clear message. And let me see if I can get some of the comments from you real quick. Fiscal policy. Wait. They said they agreed that. Let me get that actual quote for you. One of the traders in our chat room actually posted the article from Bloomberg here. So it says they agreed on the importance of fiscal sustainability. Basically, they're just not going to be flying blind, and they need to make sure that there's better communication, between monetary and fiscal policy. Which, look, I think the market is always gets concerned when random things happen, and in this case, when you have the Bank of England that's struggling to keep the gilt market supported, or they have to throw money at that, and then you have and it totally goes against what the UK government is doing. Having the fiscal and monetary authorities both talking and in agreement, that could lift the sterling going into this next week. Also, one of our traders, he's probably listening in right now, he mentioned that weekend prices on IG, even though they're not being traded, they are ticking higher. Prices are ticking higher based on that headline. So, obviously on the weekend, there's a lot of headlines that do happen. That's one thing that we do and should keep in mind. Now, I'm going to continuing on. One of the really key developments going into this. Oh, I guess let me finish up what I was thinking here. So this is the daily chart in the sterling, right? Obviously, you can say this 115 is a big deal, right? But you see, this is a 50 DMA. 50 DMA has really kept the market contained for a long time. Let's go back and review that for a second. The 50 DMA. Let me pull that out. Do this a little further. Okay, going all the way back to, let's just say when we got a severe breakage, which would have been back in what is that, March of this year. Notice that every approach towards the 50 DMA have really been rejected, right? And here we are again. So the risk is defined as long as you're below the 50 DMA. You get above the 50 DMA, and then if you were short sterling in any way, shape, or form, you really got to start being careful, because we get a sustained break above the 50 DMA, and it sits up there for a few days. Next thing you know, we might be trading north of 120. A lot of that's going to have to do with what's happening in the UK specifically, but a lot of it's going to have to be what's happening in the in the overall in the markets generally speaking. I mean, the dollar, only way it's going to really weaken is if you start to see equities rally back, which that's a tall. It seems like that's a tall ask at this point in time. Speaking of something that's just kind of nonstop, let's talk about the dollar yen. We did discuss this last week, and obviously the yen is a big topic of conversation and what is going to happen with potential intervention. Again, going back to my conversation with Mark Chandler, and if you don't know how to get to that interview, if you just go to the tradersummit.net site and you listen to this is the interview right here. It's the buy the rumor, sell the news following CPI. Actually, Mark discusses he's got more experience than most of us that have been in the markets for a quarter century. He's been in the markets longer and worked institutional side in New York, and he still lives in the city, and he's just a great person to know, and for a lot of information and education in the FX market. But talking to him, he was just like, I'm not going to ruin the interview for you, but basically you got to think about the time of day that intervention from the Ministry of Finance or the Bank of Japan is going to happen. You think about Sunday evening when the market opens. I think we need to be on intervention alert. Not saying it will happen, but look, the Bank of Japan and the Ministry of Finance are probably getting really worried with this runaway freight train. You look at the last time that they intervened, which was if you're looking at the daily chart, was back here, right? Then that after that intervention effort, and let's just talk where the market closed. It's right here. We're up another you can say the yen is another 4.5% weaker to the dollar since they intervened the first time. Now, intervention efforts, it's imagine like I use the analogy of the asteroid, and how that NASA is sending these satellites at an asteroid to just kind of knock it off course. That's all the Bank of Japan can really do, and the Ministry of Finance. They're doing their best efforts to eventually curb the move of the dollar yen. So as we approach, and you have to take a look at this, as we approach 30-year highs, I mean, we are getting to levels we have not seen since 1990. 1990. I graduated from high school in 1990. That was a long time ago. So imagine, we are seeing levels we have not seen in 30 years. That eclipses most people that are listening in right now, most people on Wall Street, their careers, right? So think about that. We're some neck-breakingly high levels. The MOF and the BOJ are probably going to resume intervention efforts probably sometime this next week, but you got to think about the time of day they're going to be doing it. And it's going to be in Asia, right? Without unilateral efforts between other central banks, they have to do it on their own. They might be doing it in Asia. That's why we should be paying attention to what happens on Sunday night, as the dollar yen did close at 30-year highs, right? So keep that in mind. A couple other things I want to talk about. And again, I'm going to say, if you are liking this video, please subscribe to the channel. Give our team a thumbs up. We'd all appreciate it. And also, check out the Trader Funding Program. They are the sponsor of today's show. The Trader Funding Program, if you want to learn how to trade our money. Actually, on Friday, I authorized two distribution payments to two traders that are in our trading funding program. So that's pretty cool. I love it when that happens, because that means people are withdrawing amounts of money after they've made money. Remember, you keep 75% of the profits, and you take none of the risk. All you have to do is pass this assessment. The assessment does have a fee. Check it out. There's a 2-minute video right at the top to learn more about it. It's right there. Going back to what I was saying about the markets, next week we do have CPI data coming out. Canadian data is expected to come in a little lighter than expected. On I believe a year-over-year basis too. It's supposed to come in at 5.1% versus 5.2% previous. The one thing about the dollar CAD is it has been in a very, very strong bullish trajectory. So if you go over to the weekly chart, You can see we are, I believe, above the 618 retracement of the last major move lower. Let me go ahead and make an adjustment here. We're above the 618. We're approaching the 78% retracement. And you can see this is a very big base. It was a channel, right? Big base broken out. And once we broke out, it's been nonstop bullishness since then. We are into, I would say, a resistance zone, whether you talk about the previous support levels all the way up to the 78% retracement. Anywhere between like 138 and let's say 141, we are in a pretty big resistance zone where it's likely that we're going to find some sellers. So since we're getting so much volatility following these inflation reports, whether you're talking about Canada, which is coming out, actually I believe that's Wednesday. Let me double check that. That is actually Wednesday morning. Whether you're getting reactions in the U.S., you're going to get reactions with Canada as well. If we get a spike above 140, and you're like, this is way overbought, we're going to revert back to the mean a little bit, maybe back towards the 200-day moving average, which is pretty far away. But if you're looking for moves like that, then I think that areas above 140 might offer great opportunities to be on the short side because you know where your risk is at, and that's the most important thing. Let's talk a little bit about trading, knowing your risk, standing in front of a freight train, especially when it's moving in one general direction. If you're trading like that, and going back to the conversation with Mark Chandler once again, we had a really great conversation. You guys should listen to it. We were talking about reversion to the mean type of trades. The reason why you can take those positions is you just don't want to risk a whole lot, but you know what your risk is. So he's like, I don't mind if I'm fading a move and I lose a knuckle. I just don't want to lose a whole hand, right? If I lose a knuckle, I know what I'm risking, but I just don't want to lose my whole hand. And in this case, when you're trading a counter trend, you go, oh, well, the dollar CAD probes above 140, the risk is above 141. Don't take a huge position because you don't want to get, hurt by doing that. Because if you want to trade in the direction of the trend, which is great, which is always the best thing, you just have to find a reversion to come back to a breakout point. Then you can trade it back in the direction of the trend. Unfortunately, these trends have been so strong that it's hard to do that at this point in time. So there's a thought with the dollar Canadian. Also, we have Australia employment this week coming up. That's going to be Wednesday night, Thursday morning. Keep an eye on the Aussie. The Aussie just continues to break lower. But, we had this reversal. Let's go over to the daily chart really quick. We had this reversal hammer. And then obviously you can see the next day that the Aussie came right back down. We haven't breached new lows. And a lot of times when you get a hammer or a reversal type of candle that you see right here, it does take a couple of days to play out sometimes. So just because we came off on Friday due to general weakness in the equity markets doesn't necessarily mean that this bounce or we can't get a further bounce here. So I'd be watching the Aussie dollar. If it doesn't create new lows, we might actually get a bounce back towards the 63.50 level, which if you want to trade back in the direction of the trend, something we've been noting all week on the free face show is, boy, if we get an opportunity to sell it at 63.60, we want to take that opportunity. Unfortunately, I think the high that we got to the day that we were talking about it was 63.40 something, and it didn't hit my order, unfortunately, to short the Aussie again. But look, that's going to be a really important pivotal area for the markets. Now, other country that's actually releasing inflation data this next week is going to be New Zealand. We got to watch the Kiwi because we are at some really, really, really critical support levels when you talk about the spike low. Let me get rid of this line really quick. You talk about the spike low on the COVID lows, after the COVID lockdown, and that comes in just below 55 cents. And you can see we're only about 100 pips away from there. You could argue that it's oversold, but you could have argued it was oversold here. So look, are we oversold? Yeah. Could we be more oversold? Absolutely. Especially if that inflation data comes in a little weak, which is going to be, let me get that date for you. It is going to be Monday night or Tuesday morning if you live in New Zealand. That data, watch the Kiwi, because obviously if it comes in light or lower than expectations of 1.5% quarter over quarter, you could see the Kiwi try to make a run for that COVID spike low, post-COVID lockdown spike low. All right. Also, one last country that is releasing inflation data. We talked about the sterling, but the sterling, they have inflation data actually Tuesday morning, and the market's expecting a double-digit print year over year in the UK. And guess what? That means the Bank of England's going to have to be a little bit more aggressive. Andrew Bailey is going to have to put his big boy pants on and be a little bit more aggressive with rate hikes. So watch UK inflation. It's only, in my opinion, it's only going to get worse going into fall. And I know you guys and gals that live in the UK are all bracing for a very, very tough winter, and as most of the global economy is as well. Anyway, guys and gals, I just want to say thank you so much for spending your time with me. Make sure you do register for the Trader Summit event. It's free, and you could automatically qualify for 2 Trader Funding Program giveaways and 2 iPhone 14 giveaways. It's cool. You can see the 8 cap giveaway right here, the Trader Funding giveaway. Why not? It's free. Throw your hat in the ring. Throw your name in the hat in the ring. How's that saying go? Anyway, you guys know what I'm saying. My name is Blake Morrow. I hope you have enjoyed today's week ahead video, and I'll see you on the free face show on Monday morning, where you're going to get mine and the rest of the Forex Analytics team's views. Thanks for spending your time with me. Have a great remainder of your weekend. Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.